Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time.
A lot of people that trade options usually trade stocks. And it's very appealing in the stock world to buy a cheap stock and buy as many shares as you possibly can. You sound pretty good at a cocktail party, right? Bottom line is, in the options world, that's not always the best way to go. And until you understand where option pricing comes from, you can make that mistake again and again. In order to understand option pricing, we're going to turn to the insurance world, and we're going to talk about a type of insurance that a lot of people out there have. They have car insurance. And if you can understand how to price a car insurance policy, it can go a long way to understanding how an option contract is priced. So, first of all, if we look at an insurance policy and we talk about the price of the asset, it's going to be more expensive to insure a Bentley than a Chevy Cavalier. The price of the asset makes that very true, and that adds cost to your insurance policy. Now, the next one is a big one. It's the deductible. What level of risk are you willing to take when you're driving your car around? And a lot of people don't like that zero deductible in policy because it's a very expensive policy. So they opt for the $500 or the $1,000 deductible. The larger the deductible, the larger risk you're willing to take on, the lower cost that policy will be. Next, we have time. And as Mother said, time is always money. 6-month policy is going to cost you less than a 1-year policy, and that's very true. So you have many different time frames that you can choose, but the more time you add, the more costly the policy becomes. Now, the next one that we're looking at here is carry costs. When you pay for your car insurance, do you pay for it at the beginning of the term or at the end of the term? You pay for it up front, and that means the insurance company has your money and they can earn interest over the life of the policy on those monies that you already paid them. Now we come down to the hardest thing to understand, and why actuaries get paid big dollars to try to figure out, is the level of risk. Is the person that's driving that car, are they a father of 5, drive a Chevy Cavalier around, or are they a Navy SEAL and they might drive the car off the cliff just to see if they can survive, do it as a training exercise? There's a different level of risk between the two, and that has to get figured out using statistical models to try to decide where that risk is at. And when that's all said and done, they give you a quote on that insurance policy, and that quote is referred to as the premium. Now, guess what? In the options trading world, there's a very similar type of pricing mechanism that happens, and that, in order to explain it, let's look at a very basic option strategy known as a protective put. It gives you protection against the downside. It allows you to put stock to somebody at a fixed price. Now, the cost of that put has a lot to do with, first of all, the strike price. That's very similar to the deductible on your car insurance policy. So let's do an example. Let's say the stock is trading at $100 a share, and you're willing to take the $500 deductible on. Well, that means that the strike price of your put is going to be the $95 strike. Why? Because if the stock comes down to 95 from 100 and goes below 92, 91, 90, you can take that stock and put it to somebody at $95 a share. All right, so you're taking that first 5 points of risk. If you have 100 shares of stock, guess what? That's a $500 deductible. If you want to take a higher deductible and do the 90 strike put, well, the price of your insurance is going to go down because of that deductible. Next, as far as carry costs are concerned, then that next component, that's also true in the options world. You pay for an option up front, the seller gets those monies and can earn interest. But there's another dynamic that's involved here in your option pricing, in that stocks, sometimes people own stocks and sometimes they pay dividend. Very rarely does Ford pay you after you drive your car around for a month and say, well, here's some money, thanks for driving my car. In the stock world, that's true, so we have to add that in, and that becomes part of the carry cost. Now, we get to the hardest thing. We've got to determine the risk. And in the options trading world, we call that volatility. To be even more specific, though, we'll call it implied volatility. It's what the marketplace is implying the stock might do over the life of the option contract. The more volatile the stock, guess what? The more expensive the insurance contract overall. So, are we talking about a stock like Tesla, which is a very volatile stock in this day and age, or are you looking at a stock like Ford that's a little less volatile? It's going to cost you more to insure Tesla than Ford because of the pure volatility, the pure movement, the daily highs, daily lows of the stock as over time, as expiration approaches. All right, now we get all these variables, put it in a pricing model, much like the insurance policy, and guess what it spits out? It spits out a price, and in the options trading world, once again, it's referred to as the premium. So that's it for today. I look forward to your questions and comments below. In the meantime, may all the options that you bought finish in the money, and all the ones you sold finish out. See you next time.